Welcome to Business with Louis, the show where we break down complex business concepts into actionable insights. Today, we're going to explore one of the most significant economic events of our time, the 2008 financial crisis, explained. So, what exactly was the 2008 financial crisis? Simply put, it was a global economic downturn that was triggered by a housing market bubble burst in the United States. This led to a massive collapse of financial institutions, a credit crunch, and a subsequent recession that affected economies worldwide. But why is this concept important in the world of business and entrepreneurship? Understanding the 2008 financial crisis can help us navigate the risks and opportunities of the global economy, make informed investment decisions, and build more resilient businesses. At its heart, the crisis was caused by a combination of factors, including subprime lending, excessive leverage, and a lack of regulation. Subprime lending refers to the practice of giving loans to borrowers who may not have been able to afford them. This created a housing market bubble that eventually burst, leading to a wave of defaults and foreclosures. Excessive leverage, or the use of borrowed money to finance investments, amplified the problem by allowing financial institutions to take on more risk than they could handle. One influential thinker who warned about the dangers of subprime lending and excessive leverage was economist Nouriel Roubini. In 2005, Roubini predicted that the housing market bubble would burst, leading to a severe recession. His warnings were largely ignored at the time, but in hindsight, they proved to be prophetic. So how did our understanding of the 2008 financial crisis evolve over time? Initially, many experts thought that the crisis was just a normal part of the business cycle and that the economy would quickly recover. However, as the crisis deepened, it became clear that something more fundamental was at play. Researchers like Hyman Minsky and Charles Kindleberger have shown that financial crises are often the result of inherent instability in the financial system, rather than just external shocks. One notable example is Lehman Brothers, a Wall Street investment bank that filed for bankruptcy in 2008. Lehman's collapse was a direct result of its excessive leverage and exposure to subprime mortgages. The bank had borrowed heavily to invest in these mortgages, and when they began to default, Lehman found itself unable to pay its debts. Another example is the story of Warren Buffett, who famously short-sold the housing market in 2006, predicting that it would collapse. Buffett's bet paid off handsomely, earning him billions of dollars in profits. However, his success was not just due to luck. It was also the result of careful analysis and a deep understanding of the underlying economics. So, what practical applications and tips can we take away from the 2008 financial crisis? First, always maintain a diversified portfolio and avoid overexposure to any one asset class or industry. This includes diversifying your investments, but also being mindful of the risks associated with any particular business or venture. Second, stay informed about economic trends and policy developments that could impact your business or investments. This includes staying up to date on news and events, as well as seeking out expert advice and analysis. Third, be prepared to adapt quickly to changing market conditions. This includes being agile and responsive to changes in the economy, but also being willing to pivot or adjust your strategy if circumstances change. Finally, don't be afraid to seek advice from experienced mentors or professionals. This could include seeking out guidance from a financial advisor, business consultant, or industry expert. In addition to these tips, it's also important to understand some key business concepts that can help you navigate the risks and opportunities of the global economy. One concept is the idea of systemic risk, which refers to the potential for a crisis to spread across multiple industries and economies. Another concept is the importance of regulatory capital, which refers to the amount of money that financial institutions are required to hold in reserve to cover potential losses. In conclusion, the 2008 financial crisis explained is a complex and multifaceted topic that offers many valuable lessons for businesses and entrepreneurs. By understanding the causes and consequences of this event, we can better navigate the risks and opportunities of the global economy and build more resilient and sustainable businesses. Remember, every great business starts with action, so take the insights from today's episode and apply them to your own ventures or careers. Be sure to like, share, and subscribe, and remember, every great business starts with action. Make your next move count.